From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, November 12th. You're listening to the Macrocast. I'm Tony Fratto. We've got Brendan Walsh and John Fagan with Markets Policy Partners with us, as always. Guys, like when we were, prepping for the show and thinking about putting together the agenda, it was like hard to not to say that inflation was going to be the top issue. It is, it's having its moment, isn't it? After yesterday's, was it yesterday's print or Wednesday's print, right?
Yeah, they pushed it up to Wednesday because of Veterans Day.
Yeah. So, so hot reading. I tried to. I made a comment on Twitter about because there was this burst of reflections on 70s style inflation, and while we're having a bout of inflation, it's not 70s style inflation. I think there are a lot of people saying things that they weren't old enough to experience at the time, which I regretfully am old enough to remember pretty well. But you had, no,
it's good. You're still alive.
I'm still alive. I'm still at it. Yeah, I just love memories of the fond memories of the 70s, despite the insanely high inflation that we had. And if you think back on that time, for the 1973 to 78 period, inflation averaged over 7%. Now,
I remember one of my friends, her father bought 30-year treasuries that were yielding like 15%, and it was right, it was like 5 years ago that the final one
the coupon
ran off.
Yeah. So by the late 70s, from the 78 to 81 period, it's a 3-year period where, or a 79 to 81 period, where inflation averaged over 12% for that period. This is right. So twice as high as this week's reading, and we could have lots of discussions as to whether the rates are comparable given the composition of the household basket and all kinds of other reasons. But suffice to say, this is inflation. It is impacting a lot of things in a lot of households, and it's real. But we have to stop comparing it to the 70s. It's not the 70s. We're in a different stratosphere. We hope we don't get there. But it's having an economic. There is an economic impact, and but I would say what we saw this week is less about the economics, so that they're real and we should get into them. But the politics of them are just really horrible for Democrats and the Biden administration in particular.
And I agree on that front that I kind of. The inflation numbers have much more to do with supply constraints, which is a federal government failure, in my opinion, than it has to do with the Fed, keeping rates low. I think the Fed has played somewhat of a role in it, but when you look at a lot of these numbers that are going up a lot of it has to do with supply constraints, and we just haven't done a very good job, fixing these supply constraints.
Well, and some of it is just these are would we, but for COVID, would we be having any of these issues? No way.
No, not at all. Exactly. Yeah.
Yeah. And so basically, the inflation lasted longer than anybody expected. You know what else lasted longer than anybody expected?
COVID.
Yeah. The Delta wave hit us just at the wrong time, just when everybody was optimistic, and it was as bad as it. Honestly, the timing was terrible in terms of the psychological impact. But we've seen when you sit down and unpack the arguments and say, there's clearly a public health issue here. Coming out of COVID, we're always going to have distortions. The point that we've made on the Macrocast before, and John Dick has made this point, the reallocation of household purchasing away from services and toward goods, that has been a market dynamic here. Yeah. And so there are all these intellectual ways that you can, unpack and explain and that sort of thing. The counter argument is, but look at milk prices. Look at milk prices.
No,
right?
but also going back to it, the way that the Fed solves inflation is to raise rates. Raising rates now might exacerbate the issue, and it could drive prices up higher, because then the companies that are trying to hire people and expand their capacity have higher borrowing costs.
It is tricky. I mean, look, I mean, we should let's talk about the economics of it, but just let's put a pin in this point, which is that there's lots of explanations. There's lots of, we can still talk about, there's still base effect things to talk about. There are supply and demand and transformation of the economy issues. There is the spending burst that came in the late winter and early spring. The fiscal spending, giving money to people that already had, many of whom already had fairly healthy balance sheets. So there was a lot going on there, lots of explaining. And to your point, John, like if you're explaining, you're probably losing, from a political standpoint.
Yeah, exactly.
Because like you're telling all these reasons, talking through, and the others, your critics get to say inflation, spending, and if that's not enough, they're going to raise your taxes too, and it is so politically, just like but just set this there, right? Politically, it's really, really tough for them, even infecting their decision on what to do with Powell. Talk about a no-win situation,
right?
Right, because if you make a change and inflation stays elevated, then you're going to get blamed for it because you have your hands on it. If you don't make a change and inflation stays elevated, then you could have done something about it and you didn't. So so the president's going to end up owning the inflation story no matter what, whether it's if it stays elevated. If it comes down, then everyone's stories sort of lock into place. Then you could say it's transitory. Some of it's not transitory though, right? I mean, like we do know that the wage pressures are probably, wage pressures are going up. Wages aren't going to come down.
Right, and the housing component really has nothing to do with supply constraints. That's going to be sticky.
So Brendan and I are long-standing. This was something we formulated last year. Our long-standing view of the inflation dynamics around COVID would be that you would get, obviously, a lot of noise and distortion. You'd have a high inflationary period during the longer tail of COVID, but that it would be transitory as you put supply chains and so forth back together. But on the other side of that would be a higher inflation plane because of the dynamics that in some ways were accelerated by COVID, but in other ways were already in train. One key one being the rollback of globalization, which was highly disinflationary. China entering the WTO was one of the, over a period of time, one of the most deflationary forces that we've seen, disinflationary forces that we've seen in global macro spheres. And this is incrementally being rolled back. There is a national security imperative of reshoring a variety of different supply lines and manufacturing chains, which are going to be higher cost here at home. And there's also the worker, the labor movement, however you feel about them, we're pretty disempowered for a pretty long period of time. And you can certainly see the pendulum swinging back post-COVID in that direction with a little bit more bargaining power at the table for labor. You also have the fact that, there's clearly like the technological gains that we're going to be experiencing over time are disinflationary, but a lot of them aren't there yet. Like the idea of sort of truck drivers being replaced by machines, that is a thesis that is coming at some point probably, but isn't ready for prime time right now. And so in this kind of temporal period, workers are going to be asking for larger pay packages, better safety, and all that stuff. And so we think that there are some meaningful forces that would put inflation on a higher plane. For the Fed, that's a feature, not a bug. like they've said, it's been hard to message this now with the spike of inflation, but in the in the dark days of deflationary COVID, the Fed said, look, this is an opportunity for us to vault to a higher inflation level. Missing the 2% inflation target on the downside consistently for over a decade is not policy success.
Yeah. Yeah, I think that is that's really important. The aim is not to get back to sub 2% inflation growth. The aim is likely to settle, above 2% for some period of time, and maybe as a perpetual objective. You're right. Look, I mean, I don't know that we understand because we haven't seen it empirically well enough just how much wages do or do not feed into inflation. How much of that is passed on in inflation. But if we are tolerating elevated inflation, it does make the challenge of real wage gains much harder. Right. I mean, and I think Jason Furman had something out, recently showing that, real wages today are, 0.6% below what they were in 2019. So, if people aren't happy about their, the economy right now, I mean, that's a decent reason, right? Is that even with all of the money and whatever, bidding for wages that's going on, it's not sufficient yet that they feel richer today than they did before. And so that's, that leads to, different economic outcomes for them, or different economic decisions for them.
A disinflationary dynamic is the one that we've been used to for the last 10 years. And it's actually, there are some things you can say about it. Japan has been in very low inflation for a very long time. It's seen as an economic malaise. It's seen as something that's very bad. Obviously, the Bank of Japan has been trying to do this vault higher to a higher inflation plane. At the same time, it's a nation of pensioners. The demographics are so old in Japan that living for fixed income and retirees who are living off savings, disinflation is awesome. And disinflation has also given the Fed the leeway to be able to do, massive rate cuts kind of whenever they want it. Yeah. And we're in a situation where the Fed was pirouetting, pivoted very swiftly away from their rate hike cycle in 2019 to essentially offset more or less the threat of a U.S.-China, the risks around a U.S.-China trade war. And they could do that even though growth was strong. They were, just hiking steadily just a few months before. The reason they could do that is because inflation was so low and so tame, you can pull a QE, lever without any sort of concerns on that front. If you're in that sort of disinflationary, it bought a lot of room on the fiscal side too, because low interest rates, it's not the debt, it's the debt service is the argument that we've heard from Secretary Yellen. And that works if you're in a disinflationary kind of low interest rate environment. So it may not be, there may be a careful what you wish for kind of element about getting back to reasonable or, what had previously been considered like healthy and reasonable levels of inflation.
Okay, I want to ask you guys something. Because here's something when we just went through a bunch of earnings, and are there more earnings next week that we have, or we're getting towards
there still is some,
right?
But basically the big guys will finish this week. Yeah.
Well, next week is the retailer. So we've got U.S. retail sale. And then we've got the gauntlet, the last ones that kind of the caboose of earnings season tends to be like the Walmart, Lowe's, Depot, and that's coming next week. Yeah. So that'll be interesting along with retail sales.
That's what those are the ones that I really, really want to see, right? Because they are on the very front edge of not just, of consumers, but also, especially in the case of Walmart, Target, on marginal consumers also. I don't know. It's like I'd even like to see what's Dollar Store and Dollar General, those guys doing also. And the reason I ask that is that what we've seen so far from from big companies that have reported is they're reporting like very little resistance to pricing. Like they've been able to raise prices and they've seen no pushback. And in fact, and some of them have reported that buyers have come to them offering to pay more to get things quicker, which is right. I mean, it's like backwards, but they're saying, hey, we'll pay you more if you can, if you can promise that you'll give it to us and get it to us faster. So there's very little pricing resistance. We are seeing, on the wage front and labor front, we're seeing like, what they call it, Striketober, and a lot of job actions going on out there. John Deere is facing a strike that I don't know who may end up being a prolonged strike. And we just said that we expect so that we know the Fed's going to take the foot off of its accommodative stance, and prices are increasing, wages are increasing. And yet people are saying they see no let up in demand, right? And we know, like, the big fiscal response that might have been expected, right? We know what's already been out there has kind of run out. Balance sheets still healthy, but have been working down off their peaks. Why is no one saying, look, demand's actually going to come off? Like, why is no one predicting demand? Because what they're saying is, like, we see demand as far as the eye can see. And I say, I don't get this. Prices are rising. The cost of producing things is rising. Easy money is coming off and fiscal support is coming off. And yet people are saying none of these things are going to have an impact on demand. Demand is going to stay just as strong as ever. And everyone's investing in output right now, which then tells me, like, I don't know, we see a glut of stuff at some point, yeah, like the semiconductors, semiconductor chips, everyone's piling into semiconductor chips, and 2 years from now, 2023, you'll be getting semiconductor chips in your Happy Meals. They'll just be handing them out.
Yeah, there was a period, and it was kind of October, as we saw the headlines about supply chain and all that really coming back in a major way. There was a sense of stagflationary risk, and there was a little bit of market volatility around that. And I think, just to your point, Tony, I think it was honestly like earnings season that really changed that. We were going into corporate reporting. The analysts were kind of bracing for management to say, this is really causing us a problem. It's playing havoc with our profitability. It's paying, our customers are taking beating on the back of this. And you saw some isolated cases of that, but that's exactly how the market kind of treated it, isolated cases. And for the most part, it was, a story about management adapting and finding ways to preserve profitability, to hold their margins up, to use, the strong demand, which they continued to say continues to look strong. And it really was, that was kind of a moment where, the stagflationary story stalled out a little bit. And now it seems like the idea that, well, yes, demand is going to stay strong, and that's actually feeding into the inflation story. And so because of this, continually strong demand, basically it's easy to mischaracterize the multi-trillion-dollar infrastructure bill as stimulus. It's not stimulus, it's investment. And it's over a long period of time. But, that story gets lost in the headlines easily. It gets lost in the political noise. And so I think right now there's, we've seen the markets responding to, recalibrating toward not stagflation, but, a higher inflationary plane, and maybe the Fed having to jump out with rate hikes. And so you see the Treasury yield curve, which is growth sensitive, and the longer term kind of growth outlook, you see that flattening out a lot. And it's because the expectation will be, the Fed is going to be dragged into, faster rate hikes earlier. And then that's going to make the longer term growth picture less rosy.
Well,
I guess, John, you brought up a good point on the infrastructure, but going back to the more partisan reconciliation bill, Tony, do you think that these higher inflation prints kind of make it more difficult
no
for this thing to be passed?
Yeah, no question at all. I mean, again, especially for like the one guy who you would ask that question to, like, you don't have to wait for, you don't
he
have
already
to
told you.
Yeah, that's right. He tweets it out, like it was his very first, tweet as soon as the numbers came out that, this inflation tax on Americans, from all of this, and he puts the blame on all of this spending, spending trillions of dollars that's creating this tax on Americans, and ironically, and so that's going to limit the size of that bill, and I wouldn't be surprised if he doesn't insist on his 1.5 trillion as opposed to, people were hoping like, yeah, he says 1.5, but we think we can get him to 1.8 or 2 trillion. I think people should dial that back a little bit to probably 1.5 trillion or below at this point. And also ironically, like, Joe Manchin's tweet that's the Republicans' midterm campaign message.
Yeah.
Right. I mean, it's like, that's it in a tweet, right? That's what they're going to be out saying. They're going to say, I'll look at all of this spending. Your real wages are down because inflation is up, and instead of helping you, the next thing that they want to do is raise your taxes. They want more spending, and they want to raise your taxes on top of the inflation tax that you're paying.
Yeah, no, it's kind of ironic because I mean, Democrats are criticizing Democrats for not actually spending anything, and so they lose on both sides of this argument.
Exactly,
they actually didn't spend anything, but they're being blamed for having higher inflation for spending a bunch of stuff.
Politics is tough, man.
I know.
But Tony, just to circle back on the legislative stuff, you made the right call. You made the right call, and
thank you.
And I were with you on the infrastructure, on the bipartisan infrastructure bill happening that week. That was a good call. We
needed Matt McDonald on this credit. Week just to eat crow on that one.
But what's your call now on Build Back Better? I
do think that a bill does eventually get done in December, and it's going to have debt ceiling in it, and it'll be reconciliation. Debt ceiling will be in it, and it'll be, my guess is it's going to be closer, like I said, to 1.5 trillion and not the 2 trillion that other people were talking about. Hey, let's come back. I want to come back after the break, and let's do a little segment talking about global risks. There are a few of them out there, and we should take a look at them. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, back on the Macrocast. Guys, it's something we've been, talking about. We want to do is just, really make sure we're taking a look at what are the sort of big global risks out there that we should be paying attention to. One of them we got a little bit of news on over the last day or so with President Biden, President Xi are going to be talking in a virtual summit, which is interesting. But I'm always going to put the U.S.-China relationship at or near the very top of my, on my global risk outlook of something to always keep an eye on. I think it's the most important economic relationship in the world, and it will be for the next 50 years. For a long time, we're going to be. It's going to be very important how these countries deal with each other and understand each other, and if they fail to understand each other, real disruptions. And the place where I think that's most likely to play out is Taiwan. There's been a lot of saber rattling over Taiwan over the past week, with a congressional delegation that went. The Chinese claimed it was a sneaky trip to Taiwan because they didn't announce it publicly and took umbrage and did a couple flyovers and some ships into the South China and the Taiwan Straits. And so, if Taiwan, if there's a breakdown in Taiwan, if China takes action to take full control of Taiwan, by force, that is one of those super disruptive events, that will not go quietly. It will have very big economic impacts, both, macro impacts for many foreign firms operating in China. We saw a little, sort of a micro event with the disruption with the NBA a few years ago. It would look it would make that dispute look like a tea party. So Taiwan would be a very big deal, and that's at the top of my list for global risks that I keep an eye on.
Yeah, from the market's perspective, we've just seen over the past decade or more, we've seen geostrategic risks, the sort of ballistics risks, really downplayed in financial markets and the way that they are, the kind of ripples that they would send. So just for instance, when Brendan and I were at the hedge fund back in the early 2000s, I covered Asia. When North Korea would shoot off a rocket, the South Korean won would fall, and we would buy it because we were betting against World War III. That was the bet, and you could pick up just a little bit of extra juice on the back of that. And then everybody sort of got the joke, right? And nowadays when there's, news from North Korea, you don't see a flicker in the South Korean won. And so when you looked at some of the other major geostrategic events and global security events over the past few years, there are only a few that really stand out as moving the needle more than just very focused regionally. One being, obviously the Iranian attack on Aramco infrastructure, where basically like half of Saudi's oil capacity was taken out in one fell swoop. A very repeatable, based on what we've heard, very repeatable kind of drone attack, and oil prices shot up, but not that much, honestly. Like, I think it went from 70 to 79 in Brent.
Yeah, it wasn't a big deal.
Yeah. And there were some real
normally it would have gone to 150. It would have doubled. Yeah.
And when President Trump had the head of the Quds Force, the Iranian, the Iranian commander taken out at the beginning of, I think it was the beginning of 2019, there was a lot of consternation about that and about that starting a shooting war that caused volatility across global financial markets. But it's, when you look at the Taiwan dollar, you look at the Taiwanese stock exchange, these are not evidencing really anything. And you look out in the region, there's not really anything you can see that looks like. Now, there's a lot of stability sort of baked into the Taiwan dollar. It's a very managed kind of currency, and the Taiwan Stock Exchange isn't particularly volatile. It's got a lot of, domestic participation. So there's a lot of kind of ballast in the hold in Taiwanese financial markets. But it's really hard to see market participants betting on a worst case scenario around that right now. But it's really hard to price it in. Like, what are the chances of it? Like 1%, like the super low probability but incredibly high impact events are impossible to really account for in so many ways in your portfolio.
Yeah, that's the story with all tail risks, right? I mean, you could try to hedge, in certain sectors you can try to hedge, but buying insurance is always expensive, right? Until an event happens,
Right. Yeah.
Right. So it's really, those tail risks are really hard to price. They seem expensive most of the time. And in a way, you'd rather just put that cash in your pocket and know that the sun is still going to come out tomorrow. But I do think you're right. I mean, there is the sort of sense of what contagion looks like, even if certain events were to exist, has greatly diminished also, so I remember, dealing my early days at the Treasury Department in the early 2000s, dealing with, this is after the 90s, right? With we had like contagion was on everyone's lips, right? There was, from Asian financial crisis, and even starting earlier in the decade with the tequila crisis, and sort of the emerging market disruptions that could have an impact in global markets and cause more knock-on effects in other countries. That was a very strongly held belief. It was something we were dealing with Brazil, Argentina, Turkey in the early 2000s, and I think in a lot of ways, in the way that I think if you multiply John and Brendan by a million traders out there who all kind of saw the same thing, that like something like, just because the butterfly flaps its wings in Argentina doesn't necessarily mean that you're going to have a tidal wave in Europe. People may have believed that, but empirically it didn't seem to be true. Kind of everybody got caught, everybody caught with a false sense of security with the U.S. housing market, right? So that butterfly flapped its wings, and it had an impact everywhere because there was not great understanding about the interconnectedness of a lot of structured financial products that were based on the American housing market, right? It just was not well understood, the breadth and depth of those products. Today, you kind of do have this feeling that everyone just sort of feels like it's kind of hard to imagine what the thing is out there that would cause a major financial disruption, or even just tradable opportunities that you saw in things like the South Korean won. All right.
Yeah, when you're looking at geostrategic issues, one of the first asset classes you look at is always oil, and there are lots of things crossing the market chatter these days about big, huge bets in the options markets on like $250 a barrel oil, that sort of stuff. That's the kind of thing that, fundamentals don't get you there, right? Fundamentals don't get you to 250 a barrel. Yeah. That is a global crisis of some proportion. That is the oil as a weapon. And we've obviously seen, the weaponized gas supplies from Russia. That's a factor in this Belarus situation as well. And OPEC has dug in and formed a pretty united front here in the defiance of a lot of major powers in the world who would like oil prices to be a little bit lower, not just the Biden administration sort of shaking their fist at OPEC. It's Brussels, Beijing. I mean, you name it. It's the OPEC is in defiance of a lot, but I think that says something here, and it's something that we're watching very closely. On the flip side, the Biden administration, they can't do a lot about so much inflation. They have some levers to pull when it comes to oil. One being the upcoming Iranian negotiations. Basically, if you get Iranian supply, if you have détente with Iran and have Iranian supply coming back legitimately onto into global oil markets, that's a swing producer right there. Yep. And then you've got the possibility of the Strategic Petroleum Reserve. And Democrats have sort of looked at President Trump, and they don't necessarily want to emulate President Trump's value system and the way he operates. But I think that the Democrats looked at the way that he took a lot of risks. He did a lot of splashy stuff. He knew that messaging and that sort of thing. He used markets as a tool to achieve policy ends. That was something that the Trump White House did a lot. And if you've got the Strategic Petroleum Reserve, that's a button you don't want to press lightly. But it is something that you can do if you've got a situation where you want to make a statement, you want to keep traders from getting too far over their skis on the long side of it.
Yeah, that may be the sort of disciplining. If you're using it as a tool to sort of discipline speculation in markets, but That, of course, is not the stated objective of the Strategic Petroleum Reserve. Which,
that is correct.
Yeah,
that's correct. But you can have the unstated objective of the Strategic Petroleum Reserve.
Definitely.
There are lots of unstated objectives in Washington, D.C.
Definitely. But you also have this just like, the contradiction of ongoing COP26 weeks and the talk of minimizing and eventually getting to net zero on carbon and fossil fuel usage, and pushing OPEC to drill baby drill and tapping the Strategic Petroleum Reserve.
It was absolutely hysterical. I mean, it can't be more ironic.
No, it's like
you're on the stage.
Yeah, it just sounds incoherent and but that's where we are.
Yeah, it's really hard to level with the American people and say, this is going to be a costly, it's not going to be necessarily the cheapest and in the current political environment, like trying to level with the American people and say, we may have to pay higher, prices at the pump as we transition in this transition process to electric vehicles and that sort of stuff. That just, you can't say that. It's not going to fly. So,
well, and then you also have the ongoing situation in Europe as well. If we could just take a minute on that with Nord Stream 2 and questions about Putin's intentions in using gas pipelines as a diplomatic weapon with Western Europe, but also just the breakdowns in their gas supply chains and their the gas markets in Europe is as we head into winter are proving troubling for them again, aren't they?
Yeah, the carbon economy will not go quietly. So yeah, it really is. It's a real issue. And Putin, they always say Putin doesn't have a heck of a lot of cards to play, but the ones that he has, he plays aggressively and adeptly. And this is one of those cards, and it's pretty clear that he thinks that he can achieve at least some form of relevance and leverage to what ultimate end. It's hard to say that the long-term strategy is all that sharply in focus, but certainly causing a lot of consternation, pain, staying very relevant. And that's certainly obviously just part of the program for them.
Yeah, no doubt. Well, we'll continue to keep an eye on all of these things. They're definitely not going away. So, guys, good show. Next week we talk about earnings. What else we got?
The retail sales is the big one, and then we also get some global inflation data from basically from all around the world. So that'll be the big one. But the retail sales is the big number of the week.
Yeah, I'm going to I do think we're going to get some inflation insights there as well, which I'll be paying close attention to. I think I may get I think I may get a whip inflation now button that I could wear. Put one of those out from the 70s. Guys, looking forward to next week's show. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.